All right, before we get into the thick of it, we have to start with this. This is for educational purposes only. It is absolutely not financial advice. We're talking about a clinical stage biotech stock today, and you have to understand these things carry extreme risk. They can move 10, even 20% in a single day. So please be careful. Okay, with that out of the way, let's dive into one of the most incredible stories playing out in biotech right now. We're breaking down BioAge Labs, ticker BIOA. This is a stock that IPO'd at 18 bucks, crashed a staggering 76%, and has now come roaring all the way back. And when I say roaring back, I am not kidding. From its absolute rock bottom lows, this stock has staged a mind-blowing 580% rally. It's a true phoenix from the ashes story. So that brings us to the big question, right? After a run like that, is bio really the next big thing? Or did we already miss the boat? Is the easy money gone? Well, let's dig into the data and find out. Here's our game plan for today. We're going to start with that wild turnaround story, then we'll look at the science. Some people are calling this a pipeline in a pill. After that, we'll check out what the chart is telling us right now, and I'll walk you through a potential trade setup. And of course, we have to weigh the huge potential catalysts against some very serious risks before we wrap up with the bull, base, and bear cases. And hey, just a quick heads up, what we're covering here is really the highlight reel. If you want the full 16-page deep dive on this thing, we've put together a professional analysis for you. The link for that is right down in the description. All right, first up, the Phoenix Rally. This isn't just a stock chart, you guys. It's a story about a company pulling itself back from the absolute brink. Okay, you have to see this timeline. It is just nuts. BioA goes public in September 2024. At $18 a share, everyone's excited about their lead obesity drug. But then, just 3 months later, bam, they have to discontinue the drug because of liver safety issues. The stock gets completely annihilated, crashing 76%. It eventually hits a bottom of just 288. You'd think it's game over, right? But no. They pivot. They shift their entire focus to a new drug, BGE 102. And what happens? Confidence comes flooding back. The big money, the institutions, they pour in $115 million at $19.50 a share. And that fuels the staggering 580% rally that brings it right back to its IPO price. Just an unbelievable ride. So what's the signs that could possibly drive a comeback like that? Well, it all boils down to this new lead drug, a drug that has some people calling it a potential pipeline in a pill. So the star of the show is this drug, BGE 102. Now it's called an oral NLRP3 inhibitor. Don't worry about the crazy name, just think of it like this. It's a switch that can turn off a really important source of inflammation throughout your body. And here's why investors are so excited. That one little switch could potentially treat a whole range of massive diseases. We're talking heart disease, obesity, even things like Alzheimer's. And that's where you get that pipeline in a pill idea. One drug that could tap into multiple blockbuster markets. And the early data, wow, this is what got Wall Street's attention. The phase 1 trial showed a huge 86% reduction in a key marker for inflammation. And get this, it showed a best-in-class ability to actually get into the brain, which is a huge deal for neurodegenerative diseases. But it's not just the science, you know? The company has a war chest of over $400 million, so they're fully funded for years. They got a massive stamp of approval with a $500 million deal with Novartis. And to top it all off, an analyst at Piper Sandler slapped an eye-popping $73 price target on it. That's a powerful story right there. Now, we're really just scratching the surface on the science here. If you want to see how this drug stacks up against the competition and get a full analysis of that phase 1 data, we break it all down in that PDF for you. Again, links below. Okay, so that's the comeback story and the science behind it. Now, let's switch gears and look at the chart. What is the price action telling us right now after this epic run? The most important number on this screen is $19.50. That's the price where institutions just bought $115 million worth of stock. So you better believe that's a huge support level, and we are testing it right now. But look how stretched this thing is, 135% above its 200-day average. That's a sign of incredible strength, but it also screams potential exhaustion. The one piece of good news for the bulls is that the RSI, our momentum indicator, has cooled off, so it has room to run again if buyers step in here. But, and this is a big but, here is a critical red flag for traders. On February 14th, the stock traded on double its normal volume, sold off hard all day, and closed right near the lows. This is what we call a bearish distribution pattern. It suggests that some big players might be quietly selling their shares right into this key support level. That is a serious warning sign we have to respect. So, we've got this fascinating conflict, right? A super strong fundamental story hitting a very critical and, frankly, somewhat sketchy technical spot. So, how might someone actually go about trading this? The main setup here is to play for a bounce off that big 1950 institutional level. Now, the key word is wait. You have to wait for confirmation, like a strong green candle. Don't just buy because it touches the price. If you get that confirmation, the entry zone is between 19 and 1950. You'd place a conservative stop loss down at 1750. Your first target would be around 22 bucks. If it hits that, you could sell half and move your stop to break even to take all the risk off the table. Target 2 is the recent highs, around 24. And if we get some good news, there's even a potential stretch target up at 28. If this works out, it's a fantastic risk-reward setup. Okay, everyone, lean in for this one. This might be the single most important slide in this entire breakdown. When you trade a biotech stock this volatile, position sizing is everything. The absolute non-negotiable rule is to risk a maximum of 1% of your entire account on this single idea. So if you have a $100,000 account, your maximum possible loss if your stop gets hit is $1,000, period. I have to say it again. This is not a normal stock, and you cannot afford to treat it like one. And of course, trading a beast like this is more than just setting an entry and an exit. In that full analysis, we've laid out a complete trade checklist and a daily management protocol designed specifically for biotech stocks. At the end of the day, every trade is a debate. It's the bull story versus the bear story. So let's lay out the main arguments for BIOA right now. On the bull side, you've got some potentially massive catalysts on the horizon. The full Phase 1 data is due out soon, a huge Phase 2 trial is about to start, and we've got an earnings update on March 19th. But the risks, man, they are just as big. This is basically a one-trick pony. Everything is riding on BGE 102. Any clinical trial data is a coin flip, make or break event. We've seen the CEO selling a significant number of shares, there's an ongoing class action lawsuit from the last drug failure, and let's not forget, the stock is already up 580%. So, with all that on the table, how do we weigh the odds? Let's try to put some rough probabilities on the most likely scenarios from here. Our base case, which we're giving a 45% chance, is that the stock just kind of chops around between $18 and $24 while the market waits for more news. The bull case, at a 30% probability, is that some positive data comes out and sends the stock up towards 30 bucks. And the bear case, at a 25% chance, is that it breaks that key support and falls below 15, which is exactly why that stop loss is so critical. So let's put it all together in one final summary. We've got a company with a boatload of cash that'll last them through 2029. We've got that key data point, the 86% inflammation reduction, driving the story. The trade setup is to look for an entry on a confirmed bounce between 19 and 1950 with a hard stop at 1750. The targets are 22, 24, and potentially higher, offering a really attractive risk to reward if the setup plays out. And that brings us to our final takeaway. The idea here is a speculative buy, but, and I cannot stress this enough, only on a confirmed hold of that 1950 support level. This is a high-risk clinical stage biotech. That 1% position sizing rule is your absolute maximum. And this goes for any investment, but especially this one. Never, ever invest more than you are truly prepared to lose.